Thanks for joining us and welcome back to another webinar organized by Princeton for everybody worldwide. Today we will talk about geopolitics of payments, the dollar, the renminbi and digital currencies. And we're very happy to have Martin Chorzempa with us from the Peterson Institute. Hi Martin. Thanks to be with us. So let me give you a few opening remarks and then we pass on the mic to Martin. So of course, the payment system is one of the commanding heights, to use Lenin's words. If you control the commanding heights, you control essentially a country. Here it's the international infrastructure. The question is, who will provide the payment system and the settlement ledgers? Of course, there are battles going on for these commanding heights between the public sector, the governments, and the private sectors. And the private sectors, there is financial sector, there's the tech sector. Think in China of Alipay or WeChat Pay. There might be X in the United States, but there's also the crypto sector, Ethereum and so forth. All of them would like to provide a payment system, not only nationally, but also internationally. And Martin will answer the following four questions. What role of the US dollar payment system has today? To what extent helps it the dominance of the dollar more generally? Do sanctions risk eroding the dollar's role? What's about the renminbi's internationalization? Will it threaten the US dollar? And its fraud politics of the digital currency, will it entrench the US dollar or will it lead to separate pipes, so some alternative payment system and settlement systems outside of the entrenched dollar system or the current dollar system? So if you think about the geopolitics of currencies, of digital currencies across different regions, I would say that the trends are the following: that the US is very much going for stablecoin arrangements where stablecoins are pegged to the US dollar. There will be programmable tokens to social networks, potentially also to other big tech platforms. And the question is how to regulate the stablecoins or not to regulate. Who gets the rent from initial coin offerings? Does it go to the taxpayer or go to private players? And how interoperable are various different stablecoins? So the US is very much going for a stablecoin framework, while China might go much more using its platform, these big tech platforms with Alipay and WeChat Pay, where the big platforms might actually then also go to other countries. It's very consumer oriented. While Europe and other emerging markets, developing economies, they can see this coming and they'll go for the digital euro and other CBDC structures in order to defend off potential stable coins coming from other countries like the US dollar and preserve monetary sovereignty in their own countries. And similarly, you see emerging markets, CBDCs coming up more prominently as well to avoid the so-called digital dollarization, these true stable coins coming from the US dollar. Now, you can also have a lot of private players, and the question is also who are the private players, and can you combine the payment ledger with a credit ledger? Is it possible once you have this digital payment ledger, you can actually extend also the credit where we go beyond collateralized bank loans, but we have a new payment ledger which allows credit extension, a much larger credit extension through fintech companies. And one question is, can private fintech companies provide that? They can, of course, provide these payment services, but the question is, will people then jump on that? And can they also extend more credit, and credit in the sense that there's less default in this credit? And actually, in my paper with Jonathan Payne, I've shown, fintech companies alone cannot do that. But big tech companies, which, also provide a trading platform on top of this fintech arrangement, they can use their own ledger token and can provide this extra credit extension. And one reason is that, the big tech platforms, they can actually force that the payment on their platform is actually undertaken by this ledger token rather than public money. And so this way they actually remove the universality of public money. And this kills hidden side trades you can have otherwise. Because when you default, you have to have some hidden side trades and you have to have some alternative space you can make your payments. You can translate this private arrangement of big tech platforms. You can also view the US dollar ledger as such a platform as well. And this might explain why we have a lot of smaller lenders across the globe being able to extend some credit and enforce credit because they're afraid if they don't enforce the credit, they might be excluded from the US dollar ledger. So you can have this as well. So let me go back to Martin, and we'll see his take on the geopolitics of payments. And of course, the Peterson Institute is very, very much interested in this as well. And Martin has a lot of experience, having lived in China, having lived, of course, being based in the United States, but also have lived in Europe, so has been in all the different continents, and has studied the payments throughout, and also has recently published a book. I think it's 1 or 2 years ago. So Martin, the floor is yours. I'm looking forward to your presentations.
Great. Thank you, Markus, and thank you for setting the stage there so well and perfectly segueing into how I'm going to start the presentation with your talk about big techs. So I'm going to start by resurrecting the ghost of Mark Zuckerberg's digital currency, Libra or Diem. In 2019, he said it should be as easy to send money to someone as it is to send a photo. And I think Facebook had very little clue, and Mark and Zuckerberg himself, the level of geopolitical firestorm that he was going to be entering by proposing to launch a digital currency. Just a basic reminder about what Libra was. It wasn't going to be fully controlled by Facebook, but a big group of other companies would be involved as well, and it would have a portfolio of different currencies that it would be based against. So a basket, so it would be somewhat in dollar assets, somewhat in euro, somewhat in yen, and others, and it would be a kind of separate global currency that everyone could use to send photos. The problem is he ran into political problems at every single level. In the United States, there was concern about the fusion of big tech company and finance in terms of competition and power at a time when Facebook was not necessarily in most trusted. And then internationally, he hit a lot of geopolitical concerns. It's kind of funny, in the United States, it was perceived as a potential way to erode the dollar, but then the Chinese head of the Central Bank Research Institute said that he saw this as a way to entrench the dollar and the US in the center of the global financial system for the future, and led them to double down on launching a central bank digital currency. And then, as alluded to in Markus's presentation, many middle income and developing economies were wondering, will we be able to have a stable currency of our own, or will everyone in our country start using Libra currency? And anytime there's a rise in inflation or some financial stability concerns, suddenly all the money drains out of the economy and causes a financial crisis. So why is it that that money is so different than sending a photo? Just a few basic reasons. One, you can send a photo to somebody and then send it to someone else, and there's no diminishing of the value. Whereas if you're sending digital money, someone needs to verify that you are the unique owner of the funds, and once you send them, you can't get them back, especially in the crypto space. Whereas if you send a photo, as long as it's not an embarrassing photo, it's not a big deal if you send it to the wrong recipient. If you're sending a different file format of photo, generally someone else can open that, no problem. But if you're trying to deal with currencies across border, you need to handle this foreign exchange conversion. That's also another complication. Another is that you can't launder criminal proceeds or finance terrorism with JPEG photos, and no economy has been destabilized by outgoing flows of photographs. Otherwise, Italy's economy would have been in real trouble, for example. Photos are not the backbone of the economy and global financial system, and so you can see that the politics and regulation and issues around payments are just so much more complicated than around photos. So I'm going to look at the way that money moves through the world today, look at the role of the US dollar in payments in relation to the dominance of the US dollar, see if sanctions risk the dollar's role, go into renminbi internationalization, what would it make it a threat to the dollar, and then end with a digital currency. So we're going to talk first about plumbing without getting your hands dirty. I've got my hands dirty going deep into this, and I'll try to make it as easily comprehensible as possible. So very simple slide here. The payment systems from easy to hard mode. The easiest is cash, right? You have cash in your hand, you hand it to someone else. That's a pretty simple payment system where everyone can just physically verify it. The problem is that's not very scalable. You have to actually meet the person that you're trying to transact with in person. There's a lot of risk bringing a load of money to a transaction. So that's not necessarily the best way to do it. Then the next simplest is an on-us transaction. So imagine I have an Alipay wallet and I want to pay someone who also has an Alipay wallet. I send that in, and all Alipay has to do is say, this account has a little bit less, This account has a little bit more. No money needs to move in or out of Alipay. Then we go to interbank transactions where you need a network that connects the banks, because obviously, if every single individual bank, which can be, thousands in the world, need to have their own individual connection to every other bank, that's a very inefficient way of doing things. So you have these interbank payment networks that handle when I say want to send money from a Bank of America account to Marcus at JP Morgan, money needs to move between those institutions. And that's much more sensitive because that tends to be very high volume kind of transactions, often leads to backing of a central bank to make sure that these payment systems interbank are stable. And then finally, cross-border, we get the most complicated where you have to deal with currency exchanges and whole different moving from one financial infrastructure to the other. That's the most difficult, and that's where we're going to spend most of our time today. So how does money move around the world? I think SWIFT is one of the least understood, very important elements of financial infrastructure out there. One thing people don't realize generally is that SWIFT just sends messages. It's the way that the payment orders move, but it doesn't actually move any money itself. And so SWIFT ensures that all the banks globally, hopefully, as long as they adopt them, are speaking the same language. Why does that matter? Well, if you're a bank and you're receiving a payment order, you need to make sure that order is formatted in the same way, no matter where it's coming from, which country, because you need to know how to route it. You need to make sure that it's passed, money laundering checks and all of that. And so you need enough data in there and it all to be super standardized so that you can make it automated. You make it automated, the payment can just go through like that really quickly with low cost. But if some individual has to verify something somewhere along the chain, it takes a lot longer. Currently, the world is moving from an antiquated 1970s standard. This is how hard it is to move from one standard to the other and how sensitive this stuff is, that it's taken us 50 years to come up with a new standard that's actually being implemented. And in the 1970s, data was actually pretty expensive. So that was focused on as little data as possible to make the payment come through. But that, of course, means many are going to get stopped. The new standards involve a lot more data, but it's a really tricky global effort going right now. How does this relate to geopolitics? Well, SWIFT is pointedly not based in the US. It's based in Belgium. So it's not directly subject to United States jurisdiction. And it's the dominant way that the banks send these messages saying, someone from my institution wants to pay your institution. How are we going to route this money? Just under 45 million messages were sent per day in 2022. You can tell that there's been a lot more sensitivity about SWIFT since this because they don't report these statistics anymore. So it's getting stale, and that's unfortunate. But this is a currency agnostic system. You can send renminbi, you can send Polish zloty, you can send euros or dollars. And US sanctions, however, are still a challenge, and we'll get into that a little bit later. So then the other part, if SWIFT is just sending payment instructions, then we get to what's called clearing and settlement. And this actually routes and moves the money once we kind of agree this is a legitimate payment from my institution to someone in your institution. The money value has to actually move. The two biggest systems for this are Fedwire and CHIPS in the United States. The Fedwire is a gross settlement system, so you send a payment, it goes kind of immediately. That handles $4.5 trillion a day in 2024. And CHIPS in New York is a netting engine. And these are really interesting because if you think about two banks, let's say Bank of China and Industrial Commercial Bank of China, there are going to be clients between those that are sending, thousands, if not millions of payments back and forth with very high volume. And it might make sense to just, instead of sending it one way and then sending some of it back and then sending it back and forth, you can save a lot of liquidity just by saying, if we trust each other enough and we are sure that this system has a backstop, we can just kind of wait until the end of the day and see on balance, is there a balance that needs to be paid from this way or the other way. And then the only question is there a shortfall? Does someone have enough money to make that up? That's why usually there's a central bank. In this case, it's the New York Federal Reserve, which backstops the system to say, we're going to let you do the efficient netting and we'll make sure that you will always be made whole in this system. And that generally makes things very efficient. So this part is really important, and note that this is the actual movement of money is separate from the messaging system. And with that, yeah, go ahead.
Can I ask a quick question? By FedWire, you mean FedNow? No.
FedNow is new. FedNow is more of a retail instrument, and I think they've had some real struggles to get that working. But FedWire is a wholesale, a bigger kind of wholesale system.
But it's also real time, immediately. So
Yes, FedNow is also real time, and so there's this really interesting tension between the desire to have instant payments that come through, and therefore there's kind of limited risk, but then you have to deal with the question of recourse. If you send it to the wrong person, if there's a delay in the settlement of that payment, you can sometimes, if it's a fraudulent payment, for example, you can intervene and stop that payment from going through before it actually goes through. But if you send it and it clears immediately, one, you have the liquidity issue of potentially needing more, and two, you have the risk of, things not being able to get that money back. And FedNow is a really interesting system where they're trying to kind of deal with more real-time payments for individuals, because the corollary of the netting is that the money hasn't actually moved, even though someone who has that account might be able to use the money right away.
and the chip system, it's netted once a day, but often the payments take 3 days to be, it's withdrawn from the sender immediately, but the receiver only gets it 3 days later or even more, a few more
Yes.
days later.
So the banks have an incentive to delay and hold the money because they can often, make interest or save liquidity while they're holding onto the funds. And so this is one of the tensions where the banks make money on this. It's called float, and they like that. And so they don't like systems like FedNow, which would move people to immediately clearing transactions where they can get access to the money right away.
You talked about FedWire and chip in US. What's about in Europe? Do you have different systems, or in China?
There are different systems in China. I'm going to get into a little bit the infrastructure there, especially the cross-border interbank payment system in China. In Europe, there's the Target 2 payment system across. Each kind of has their own different domestic payment infrastructure. And then the interesting thing is, how do those communicate between each other? That part is really complicated. But I don't think there's generally that much variation in the way that these systems work. I mean, some are more developed than others, and the US is often viewed as actually a laggard despite its dominance of the US dollar globally and global payments. It's often takes longer for them to do anything new, including the real-time payments.
Thanks.
So one of the interesting things that I discovered in delving deep into these systems is that it's actually really hard to describe a simple question like, how does money actually move if we pay each other? If I want to send money to Germany, when Markus has an account there, where does the money actually go? And the answer is even really smart people won't really be able to tell you, because it really depends on the bank, it depends on the time of day, it depends on so many different things. There are all different paths it can take. So this is just an extremely complex area. But one of the things that's important to note, as Markus was alluding to, there are other payment systems, and I'm going to get into the US dollar dominance, but very few non-US banks and no non-banks have direct access to this key infrastructure that I described, the chips and FedWire. And so what that means is they have to access it through a foreign, generally the largest foreign non-US banks have a subsidiary in the US that has access to those pieces of infrastructure, but everyone else has to work through someone who has direct access. And that's called correspondent banking. So you have a chain of banks. Let's say, again, I'm banking at Bank of America and I'm trying to send someone money in Pakistan. It's very unlikely that Bank of America has a direct relationship with that Pakistani bank. So it has to go through a chain of different banks and try to figure out how to quickly get to that ultimate recipient and kind of hand it off like a baton in a relay race. And one of the big challenges that's happened over the last years is that there has been increasing risk aversion in these correspondent relationships where, thinking about the big bank that might have a relationship with that Pakistani bank, if there's any sort of scandal about potential terrorist finance or money laundering going on with that Pakistani bank, whoever has access to the US infrastructure might get fined or sanctioned in a way that would put a lot more money at risk for them than what they would possibly get from that relationship. So you see this chart here shows there's been a significant decline in the number of correspondents. And what that means is for many people around the world, the correspondent banking system as it stands today with the dollar at the center takes longer for your payments to clear and can be more expensive because each link along the chain takes a little bit of money in exchange for doing that.
Just to make sure I understand the figure, there's active corridors. You have, and this on the x-axis. What's on the x-axis? The number of days, or
X-axis is the date. So that's 2012, 2013, 2014. So the latest data we have from what I've seen is 2019, and you can see a 20% decline in a relatively short number, 6-7 years in the number of correspondents. And it's happening all over the world actually. And the active corridors mean, a direct one currency, to one jurisdiction to another jurisdiction. That's declined a little bit less. But there's now more concentration, which means if you're part of that corridor, you can make more money.
but
Which
is it
means
because
more
there's
expensive
some
payments.
fintech and Bitcoin and cryptos guys moving in and driving out these correspondent banks, or
It's more risk aversion. It's kind of what I was describing that, you might have had a lot of correspondent relationships in the past, but with the elevated risk of getting a big fine for a money laundering violation, you're going to look at, any of those relationships that are relatively small, and say the risk reward is just not worth it for us. So they just kind of shut that out. And then whoever banks with those smaller institutions in the less developed economies have less options and have to stretch further before their kind of bank will be indirectly linked with somebody who has access to that USD infrastructure. So now we'll get to dollar dominance. The US dollar is incredibly dominant in payments, far more than any other indicator that I have seen anywhere. So the US dollar, according to the BIS statistics, is on one side of 88% of foreign exchange transactions. That is just astounding. And if you look on the left, I know it's a complicated chart, but if you look at the left, you can see the US is something like 20, upper 20s share of GDP globally, and much smaller, maybe 10% of global trade. But then it's something like 88% again of FX turnover, and you can see the green line is the US dollar. It's way higher than its role in the global economy and in trade invoicing, in international financial indicators, and just about everything, including about 50% of the total value payment messages that are sent over SWIFT. So essentially, global payments are massively centered around the US dollar. Some of the reasons for that, yeah.
So there's, of course, the dollar is a vehicle currency. If I want to swap something from Peruvian currency into, let's South African rand, I go through the US dollar. Is it because the liquidity is high, or is it because of this back in the payment system? It's so complicated.
It's both. I'm actually going to get right into that. So
Okay.
that's related to Ray, wonderful 1999 paper on what she calls a thick market externality. So because there is just so much liquidity focused between any currency and the US dollar, that means it's a super liquid with much lower spreads, and it's much less expensive to hedge. And so that means it's kind of crazy that it's this way, that it usually costs you less. If you're, say, in Korea, it will cost you less to go from Korean won to dollars and then dollars to renminbi than it will for you to go from, and so that's two different transactions that you have to pay transaction fees on. Costs you less than going directly from the won to the renminbi. And so think about it like a transit system with a central hub with a super fast train system. You might have 2 points off on the side, and the fastest way is actually to go into the center on a fast train and back out on another fast train versus trying to connect on some old broken down road in a bus that runs once every 2 hours directly between the peripheral parts of the city. And then there's also just so much reinforcement of the different roles of the dollar. So because dollar invoicing is dominant, demand for that leads to demand to hold dollar assets against that. One of the interesting things about this, there's a big debate in the economics literature now about the extent to which these network effects make it really stable, the US dollar dominance, because Eichengreen and Flandreau have a really interesting paper showing that when the dollar actually didn't, at one point flip over and become the hegemonic currency, it actually coexisted in a multipolar system with the pound for a while. And that might be what leads us forward. To really flesh this out, I'm just kind of want to give you an idea what it would be like for a typical firm in, say, Indonesia, using the dollar as a vehicle currency. If you look at this chart, US dollar shares in exports and imports, Indonesia is the gray line. It's something like 90% of export dollar are settled in dollars, and 80% of imports. So what does that mean? You have some domestic currency costs in labor and taxes, but exporting your goods, that's mostly all invoiced in settled in dollars. Your imports are invoiced and settled in dollars. And so if you hold US assets, if you borrow in US dollars, that's going to help you balance the risk involved there. So you can see that's where a lot of this complementarity comes in. And it's cheapest to hedge because you don't want to be in a situation where you import when the US dollar is expensive, and then by the time you actually made the thing and exported, the dollar has gone down. It's cheapest to hedge that versus any other set of currency. So you can see how this just hypothetical firm is choosing the US dollar for purely economic reasons. Nobody's telling them to do so. It's just by far the best deal for them
But
to
this
do.
does not mean, in contrast what the literature assumes, that prices are sticky in dollars. No? You can still modify the dollar price every second if you wanted to, I guess.
Yes, that's true. So there's a really interesting whole literature on the impact of USD invoicing and how this works. But I'm just trying to give a very basic illustration of how a firm is thinking about, I want as little currency risk as possible, and whatever currency risk I have, I probably want to hedge that if I can. And the level of liquidity and how everything is just in dollars, it really simplifies things for a company that's doing this. So now to where the payments get really geopolitical, more than any other area, and that is sanctions. So former Treasury Secretary John Connolly has said the dollar is our currency, but it's your problem. He meant that in a different context than sanctions, but I think it still fits quite well. There's a really interesting book by Daniel McDowell called Bucking the Buck, and he's looking at to what extent do sanctions lead countries to go away from the US dollar. And he finds really strikingly that even the countries that are at most risk of getting hit with US sanctions, they don't reduce their dollar use until after sanctions are imposed. That is how costly it is to move away from the US dollar. They generally only do it if they're forced to do so. So then what do sanctions do? Treasury's specially designated nationals list has this most severe blocking sanctions, and that says you essentially can't do any deal of any kind with any US person. The reason that this matters for, say, a Korean firm or Indonesian firm is that once you become a sanctioned entity, you become radioactive to anyone needing access to that key US dollar infrastructure, because anyone helping a sanctioned entity is likely to get sanctioned themselves. And so that is the reason why SWIFT, though it's located in Belgium, complies with US sanctions, because all non-US banks with any sort of international business generally have to. And it's really hard to work around these. So the EU tried to create a system to allow payments to Iran. That failed just because anyone who then in turn dealt with that entity, which would certainly be sanctioned, would be at risk of getting sanctioned itself. But very interestingly as well, if you look at the use of US economic tools against China, there are all these export controls and actions against Huawei and other things, but the US hasn't put any major sanctions on any major Chinese institutions. And why is that? It's because you would have such a strong, these are such powerful weapons that it's kind of like a nuclear option that would force China to have to really move away from the US dollar, force countries to choose, and the US has realized that there would be serious negative spillover effects. And we've seen that in some cases, in Russia, for example, when sanctioning an aluminum company snarled a bunch of supply chains. So the US has to be very careful with these despite their power. I'll do just a case study on what the sanctions looked like and how the geopolitics of payments shifted with the Russia invasion. So Russia was sanctioned to a much lesser extent than 2022, back in 2014, and so it prepared for much worse sanctions before it invaded Ukraine. They activated what they called a Fortress Russia strategy. They created their own domestic payment system that could be activated when Visa and MasterCard exited the market, and they increased their reserves in just about everything but US dollars. But I'll just skip quickly ahead here. You can see Chinese-Russian trade, despite this Fortress Russia strategy on the payment side, everything 2019 and 2021 is essentially zero transactions using the renminbi. they're mainly still using the dollar at this point, underscoring what McDowell has found in his book. Russia was surprised by how the U.S. and a whole coalition of other countries sanctioned major Russian banks and other entities, and this could have easily led to an exodus from the U.S. dollar, as many countries who might think, oh, I'm going to get hit by sanctions, I need to do the same. But if you look at it, even the Swiss and the Europeans and everyone all major reserve currency issuers imposed sanctions themselves, and that meant there's really nowhere for you to go except potentially gold. One mistake I think that the sanctioning coalition made was to try and simply cut some of these institutions in Russia off from SWIFT, separating, that they weren't actually put under these full blocking sanctions, which would have de-SWIFted them anyway, but kind of politicizing the infrastructure, which I think should be as neutral as possible so that we keep all the banks in the world speaking the same language. Russia moved to the renminbi, as you can see from this chart, but you can also see that it declines. And the reason for that is that the US secondary sanctions are so powerful that it actually led major Chinese banks to have to pull back from Russia business that they initially were enthusiastically supporting because they couldn't risk getting sanctioned themselves. The Russia business they would gain from violating sanctions was not large enough to justify the potential dollar business they would lose if they were seen as sanctions busters and got themselves sanctioned.
But so the US can, they're very powerful if you use the secondary sanction mechanism as well. But the US can, use it only for first order and not second order, not third order or something like that. It's up in the hands of the United States, I guess. A lot.
Yes, it can always choose. It can follow you to the ends of the correspondent banking chains. And so some small Chinese institutions have continued to do this kind of business. But any real embrace of this kind of transaction creates the risk that you'll get secondary sanctioned. And the reason that this reversal kind of occurs here is that the U.S. made clear that it was going to start applying secondary sanctions, and that was aimed pretty squarely at China and had a real effect. China's trade with Russia is in part, even if it's denominated in renminbi, is still to some extent, able to be blocked by U.S. sanctions.
How does the crypto space come in there? Is this an alternative for Russia and China to pay each other, or?
I generally think that the crypto elements are overrated. Crypto is not actually that useful. It's not that accepted in generally. Probably more it would be gold, but what they've done instead is create a kind of almost barter netting system where a company from China that sells a bunch of vehicles to Russia, for example, gets kind of credits back, and then someone who's importing something from Russia gets it. And so they've created the kind of EU Instex thing, but with a lot less transparency. And so far that has worked to maintain some of these relationships. But I think crypto it doesn't have the level of volume that's required for these large scale trading transactions, and also the reliability. If you make one mistake in your Bitcoin transaction, you can lose the entire amount in your wallet. So it's a very risky proposition to be using.
Do you see that one question from Maurice is the Trump administration acting much more aggressively on that compared to the Biden administration? Do you see big shifts there in terms of sanctions imposing and also weaponizing the dollar?
We haven't seen any shift on that yet. I think that he's threatened serious sanctions against Russia, but it's really unclear where that's going to go. And then on crypto, obviously, he's much more positive than the Biden administration, both in the stablecoin case that we'll get into, but also in generally cryptocurrencies. So no kind of tougher action yet on these, but it's very early days in this administration.
Thanks.
So there's some erosion. I won't spend too much time on this. Some erosion in the U.S. dollar in terms of the share of reserves. So the interesting thing I want to point to you here is, the red line on the left chart goes down a little bit, but it's still just far above anyone else. And the euro is quite stagnant. It could begin to go up now, but not yet in these data. And the most interesting thing about this is that it's really not coming at the expense that the renminbi is not gaining at the expense of the dollar very much. You can see the green on the right is the amount that the renminbi is getting, and it's about the same as these other gigantic titans of global finance, Australia and Canada. So it's really not digging into the US dollar in
What is
particular.
this other, this gray area?
So that would be all other economies. Essentially, the takeaway from this research that Ike and Green and others have done is that the erosion in U.S. dollar dominance is driven in reserves is driven in part just by trying to get more yield and diversification, as their reserves are so high, they're not really needed for short-term debt payments and imports. So they can spread and try to get a better return in some of these smaller markets rather than just being all in USD, which has had its yields in general up until recently quite low. So at the same time, however, the many underpinnings of the dollar dominance are in question. Not all of them are related immediately to payments, but due to the fact that these are also mutually reinforcing, it's an interesting question. So this kind of is based on some of my takeaways from a great session we had at Peterson Institute on a new Mar-a-Lago Accord, where Markus spoke and also Maury Obstfeld and Adam Posen. And some of the underpinnings of the dominance are rule of law, independence of the Fed, open capital account, and also that there will be sensible economic policy, which is all in question now. And the chart here that's really interesting is looking at the credibility of the security umbrella. It's another Ike and Green paper with others, and shows that many of the U.S. closest security allies have much higher allocation of dollar reserves than we would expect otherwise. And the interesting thing about this is we just really don't know what are the main factors that are the really core factors that lead to dollar dominance, because the dollar has been dominant for so long, and there's been very little movement in general towards another currency or in many of the things like rule of law until very recently. So we don't really have enough power to be able to tell which of these is the most important underpinning and what might undermine it. That comment came from Eroding from the IMF, a comment on a paper that I gave. So the dollar, as Larry Summers has said, is fortunate in its alternatives, and in that even if the dollar has these challenges, it's not clear that the challengers are any better. So briefly, before I get into the renminbi, there's been longstanding economic and political concern about over-reliance on the US dollar, and part of it is about sanctions. Part of it is also about just the economic spillovers and risk of having your entire trade with the rest of the world in a currency that you don't control and could be at risk. So one of the interesting things I discovered in looking into this that I found just shocking is that literally there was not a way for you to trade directly between the renminbi and the Japanese yen before 2012. And there was not a way for you to trade between the renminbi and the yuan until 2016. So that just tells you until very recently, the dollar was just kind of the only game in town. It also tells you that that's beginning to change. So the picture on the right is showing Indonesia developing these local currency settlement systems where they try to figure out, okay, we're gonna start figuring out how to trade directly between our currencies, which often means you authorize a bank in the other jurisdiction to start handling foreign exchange. Problem, these are growing quickly, but they tend to be very thinly traded. That means they're expensive, they're not really able to be hedged, they're not ready for prime time. So these are more kind of insurance that could be activated if the US put gigantic sanctions on or something, but they're not really alternatives to the US dollar at the moment. Just very briefly as well, looking at China before we get into some of the government-led initiatives, there was a time not that long ago in 2016 when it looked like Alipay and WeChat Pay were going to take their dominance of the Chinese fintech space and really become a challenge to the US dollar and global payment networks like Visa and MasterCard. They did a lot of expansion, but it all failed. And one of the interesting reasons for this is that it is geopolitics. So the Alipay tried to buy MoneyGram, a major remittance payment provider in the US that was blocked on national security grounds by the US government. Kind of not surprising, but what's maybe less known is that in places like Indonesia and elsewhere, there's a lot of protectionism, that these markets for payments, and in particular sensitive data, is such that they don't really want to allow foreign players in, and even if they maybe already allow Visa and MasterCard in. And so the Chinese were not allowed in. They also made some business mistakes. So far, one of the most promising potential areas for them to make inroads hasn't really had them make inroads. They're doing other things, however. There are swap lines that make the renminbi available in more countries. Those haven't really been drawn on very much, haven't made much of an impact. They're developing this new interbank payment system that I'll get into in just shortly. They're trying to connect more regulated onshore and less regulated offshore markets so that international investors can get access to Chinese assets. And they've been developing a digital currency. They've also taken somewhat the opposite approach as Russia with a further integration with SWIFT rather than trying to separate themselves from it. And just recently, they've been telling state companies to use the renminbi for global expansion, again, trying to get around those potential secondary sanctions. But what's been the results?
Yeah. To integrate further with SWIFT for the Chinese?
Not actually. So I'll get into this a bit, but the CIPS system actually uses SWIFT for the communications with the global banks that are indirect members of the CIPS system. So actually using China's payment system involves still using SWIFT. And SWIFT has also created a JV, a joint venture in China. And I think their overall idea is to make it too costly to sanction them because they're so connected. One of the takeaways you can give from the Fortress Russia thing is that because Russia was so isolated from the global financial system, it wasn't as costly to sanction them. But if you're super networked with the rest, then it becomes extremely costly.
Because you only then use the nuclear option and cannot scale it up little by step, or?
Yeah, I think they want it to be too difficult to sanction them. That it would be mutually assured destruction, and that's one way to do it. But they're also looking at alternative ways that they would be able to turn on if they were de-swifted, for example. So the renminbi is punching significantly still below China's weight in trade and investment. It's rising in terms of global forex from 4% to 7%. Remember, the US is 88%. But even now, only 25% of China's trade is settled in renminbi, although that's rising fast. I'm going to try to speed up a little bit so I don't go too long here. The CIP system is interesting because it's introduced in 2015 to facilitate cross-border renminbi use. And a lot of people call it, this is China's answer to SWIFT. It's a replacement for SWIFT. And that's not exactly true. One is that it's more than SWIFT because it includes clearing and settlement. So that includes the things that CHIPS or Fedwire would do. It is a real-time system, real-time gross settlement like Fedwire, not like the clearinghouse interbank payment system. But it currently, as I mentioned, needs to use SWIFT for messaging with global banks because global banks are just so reliant on this system to all speak the same language that it doesn't make sense for them to create a separate integration. Although it does have its own messaging system, it's only used for the direct participants, which are all Chinese institutions. There are about 170 direct institutions and then 1,500 indirect. You can see from the chart here, this is the CIPS transactions. It got squished a little bit. But it rises pretty substantially, but slowly in the wake of the Russia invasion of Ukraine, and then spikes in 2024 in part due to the secondary sanctions threat that might have moved more transactions away from the US dollar towards the renminbi. But it's important to note, even though these are pretty high numbers, we're talking about billions of renminbi a day, a few hundred billion renminbi a day. It's just a drop in the bucket compared to what goes through New York at any given time. Renminbi faces a lot of headwinds. The most important is probably capital controls. You just don't know if you'll be able to get your money out. You can't really be a reserve currency if you're some institution that's holding reserves in renminbi when there's real instability and they need that money. If it's locked in China due to capital controls, it's not very useful. There's also lack of trust, lack of rule of law. There's not an independent central bank. And we have a chicken and egg problem for liquidity, which is, you don't have that thick market externality of the US dollar, so it's much more expensive. And, if it's more expensive, people don't use it. If people don't use it, you don't have liquidity. So you can think what they would probably have to do is try to generate a lot of liquidity using state banks or something if they really wanted to get this use of renminbi off the ground. And then going back to that geopolitics, they just don't really have solid allies. And the best chances they've had to gain volume for renminbi, for example, transactions with Russia, actually create a sanctions risk for global banks that make it less useful there. So then I will move to digital currency. And one of my favorite topics would...
A quick question about this
Sure.
Chinese system. They are working with SWIFT at the moment, but is it set up in such a way that they can break themselves away from SWIFT down the road?
I think they could.
A transition phase for them to work with SWIFT?
It's possible that it's a transition phase. I think it's more that, again, insurance policy that the thing to watch will be what international institutions, big international banks agree to become direct participants and then message each other directly without SWIFT. So what is clear is that just like Russia, if SWIFT suddenly shut them off at one point, the Chinese banks would still be able to pay each other without an issue. And the way that regular retail people make payments would still be able to happen. So digital currency, I thought I'd include a meme because we're moving into the younger digital currency tech world. There has been so much concern about the digital renminbi in Washington. They imagine it as this huge behemoth that's going to, take over from the US dollar and surveil the entire world. And then what you see, in fact, is that even Chinese in this, despite all of the state-led push to adopt the digital renminbi, Chinese consumers say, no, I'd rather buy my noodles with Alipay. I don't really have any desire to use the big fancy state-backed digital currency. So you can see the people who actually pay attention find that digital renminbi is not actually that scary. Basic taxonomy of digital currencies. One thing people don't generally realize is that essentially all of the big deal payments that we talk about so far are already digital. Credit cards, everything on chips, that's already digital money. We're not talking about analog cash here that's getting replaced. There are decentralized digital currencies that fluctuate in value. These tend to have very low throughput. So Bitcoin, for example, can handle like 7 transactions per second. And Alipay can handle 250,000 transactions per second. One of these is not really going to take over as a global payments currency. Stablecoins are designed to have stable value versus fiat currencies, and these show, I think, the most promise in terms of the payment space. And then finally, we have central bank digital currencies, which are liabilities of the central bank. These can be retail, which means they're available to the public. This is really the thing that's new in central bank digital currencies, giving individuals a digital form of central bank money, because all the forms of digital money that people generally have access to today are not central bank money, they're commercial bank money. It's, that Bank of America liability, not the central bank. In the wholesale space, there is already access to digital central bank money. So I sometimes struggle to see what's actually the difference when people are talking about wholesale CBDC. China.
You can make it programmable, I guess, and link it to other ledgers which are outside of the central bank universe.
Yes. So the interesting thing about it is not necessarily that it's direct central bank money. It's about expanding access to this infrastructure or building a new type of infrastructure, potentially based on distributed ledger technology that allows for new interconnections. Yes. So China is by far the most advanced large economy in central bank digital currency work. ECB, as Markus mentioned, is also one of the most important. But everywhere that CBDCs have been tried in the retail space, they have completely failed to gain traction, including in China. You have central bank officials in China saying, why can't we get anybody to use this thing? And in the cross-border, and so what I would direct you to is the tiny red bar on the far right chart on the way bottom, which is working on a live CBDC or a live CBDC has been issued. And that's effectively just about at zero among all the different central banks in the world. So although they have FOMO, they're afraid of missing out on digital currency revolution, there's almost nothing that's been launched yet. And that means the digital renminbi doesn't have a launched central bank digital currency of other major economies that it can connect to and can build a network. That doesn't mean they're not trying. So that gets to Mbridge, a really, really fascinating case. Was designed to create a new system for CBDC to CBDC payments, wholesale, without needing the US dollar or any of the kind of payments infrastructure we talked about, SWIFT or chips or Fedwire or any of this. It would be direct interconnections. And it was under the Bank for International Settlements, which is a neutral international institution based in Basel. One of the interesting things about this is that the PBOC in China actually wrote all the code for this thing. It was always geopolitically very on tenuous ground because the US is a major force in BIS, like in most international organizations, and isn't always very enthusiastic about ways that people might try to work around the US dollar. This became a M bridge too far in late 2024 after Putin and Russia proposed a kind of BRICS bridge payments idea that was clearly inspired by M bridge. It was going to be a new kind of payment system that would allow them to skirt sanctions. And that at that point, it was no longer tenable for the BIS to be involved. And then the managing director of BIS, Augustin Carson, said we have to be, we should not be a conduit to violate sanctions and had to pull out of the system. So it's currently really unclear whether it will continue among the central banks that were part of it or if the project will die. But that just tells you it's very tricky to put together a challenge to the US dollar. Now to stablecoins. This is a chart. Sure.
Why does the US not set up a system which is more digital and more efficient compared to SWIFT?
So SWIFT is already actually quite efficient. The real challenge is around access to the infrastructure. So the US has strict rules around who can access the USD clearing infrastructure, and it's very clear that non-banks cannot be a part of that. So it limits what we're able to do. I've always advocated for updating the USD infrastructure, making it more accessible and more efficient in some ways, but it's a very slow-moving system, and CBDC in particular is a political non-starter in the United States, in part because it would take over for the state functions that are currently done by the private enterprise.
Well, can you see X and other fintech or tech companies going into that space, like what
Definitely.
Facebook tried to do?
I think they will try to, but the competition policy challenges are pretty large. They would have to access the infrastructure through banks, so they have to find partners who are willing to provide that access. So far, the super app model hasn't really worked very well outside of China. So I would be suspicious that X would be able to parlay its current user base into, and kind of the lack of trust that people often have in the platform, into a real payments platform. But what I think is the most promising is probably stablecoins here. So looking at stablecoins, do they reinforce US dollar dominance? So far, the answer is definitely yes. So current Treasury Secretary Scott Bessent has said we're going to be the dominant reserve currency, and we're going to use stablecoins to do that. This chart shows you the transaction volume by stablecoin. You can see it's essentially a just two stablecoin race, USDC run by Circle and USDT, which is run by Tether. Both of those are US dollar pegged stablecoins, and they're essentially the entirety of the volume. And the volume here is actually, it's grown quite substantially and could be poised to grow far more if, as is currently anticipated, the Genius Act passes and kind of fully legalizes stablecoins in the United States and creates a regulatory regime for them. So that would both create demand for U.S. assets to create the backing for those stablecoins, and then potentially get into some interesting geopolitics. So we would have the stablecoins would likely take a lot of cross-border payments business from the banks. That could lead to a lot more competition, could work against that issue of shrinking correspondent relationships. But it could also lead to the same kind of things that people were concerned about with Zuckerberg, where if anyone in Argentina or Turkey can get access to US dollar stablecoins, it could lead those countries to dollarize, digital dollarization, and become less stable because it's not easy for people in general to get their hands on digital dollars. You can't just as a foreign national just get a dollar account necessarily very easily, but they could easily do capital flight into these digital currencies. They're also probably going to take some volume from Bitcoin because Bitcoin is a lot less useful for buying day-to-day things than dollars, and it's a lot less stable. So if you want to hold a stable source of value, this could take that share, and I think that's in the minds of the U.S. Treasury as well. It also raises really thorny questions about regulation and backstops. These are kind of like money market funds that don't pay any interest. And the real question is, if these get really, really big, is there going to be systemic risk? And then we're creating potentially an expansion of the safety net for what could be a systemic payments institution that you don't want to break the buck. And for really shady, I would say, unregulated players, potentially like Tether, that could be, we might not necessarily want to extend the safety net to there. And then getting into your question about CBDC and the US, if the EU and China and others end up having a wholesale central bank digital currency infrastructure, and as the BIS has underscored, generally these kind of infrastructures might only accept central bank digital currency, and the US only has a private stablecoin with unclear solvency, it might not be able to interact with those infrastructures and remain as dominant as it is today. So these are some of the more interesting
Can you elaborate on
questions.
the latter a little bit further? So let's suppose we have a CBDC wholesale or retail, or let's say wholesale. And in the US, we have private stable coins. There's some frictions in international arrangements then, or can you expand?
Sure. So the wholesale payment systems generally tend to have backstops and are generally run by central banks to ensure that there is no risk whatsoever that we're going to have something like the Hashtot issue, where some institution is in a net negative position and fails and isn't able to bring through the payments that that other institutions are relying on. And so the interesting question here is, if we have a new breed of CBDC-based wholesale cross-border infrastructures that are CBDC to CBDC, it's not obvious to me that they would let a private stablecoin like a USDC be a part of that system. They might say, no, it has to be, this is a system of only central bank liabilities with central bank backstopping, and we're not going to extend that to a private stablecoin. So that's something that's many years in the future, but that's just something to recognize. Like you wouldn't be able to just come in and participate in some of these infrastructures as a private firm with kind of private liabilities that are not backstopped by the central bank.
But it could be a European regulation, say a US stablecoin, if it's a near bank regulated for 100% backed with US treasuries, you might let it in. If it's not 100% backed, you might not let it in. So then the US stablecoin rules would be actually made by the Europeans. Is this crazy?
It's possible, quite possible. Of course, holding a lot of treasuries could lead in very recent memory, in like the last few weeks or month, could have led to significant losses that could lead them to break the buck if they had longer term treasuries. So even that is not necessarily enough to be as stable as the full backing of the full faith and credit of the United States or another country. So I'm kind of skeptical on this, and I think the U.S. needs to be, at least tracking, making sure that it would have some form of digital dollar in the wholesale space that would be able to connect to these infrastructures. So I want to just conclude quickly with some of my takeaways from doing work on this area for a long time. And one of them is that technology matters a lot less than you initially think. I've gone all the way to the extent of reading applied cryptography books to understand how blockchains work. And technology can shift the political economy, but really what seems to be the most important drivers for payments is trust in the institutions. That's something that the digital world, all the blockchain systems can't really substitute for fully. And then access to the infrastructure. Expanding access would be extremely powerful for bringing out more competition and more access, more financial inclusion around the world to these payment systems. And then connecting the payment systems themselves, I think the technological element's actually the easiest part of it. It's not about whether we can come up with some clever blockchain-based tokenized system that solves all the issues. I think it's much more about how much trust do we have between these payment systems that have to interoperate with each other, where we have to make sure that there isn't going to be a violation, and then legal certainty of knowing, combining these two potentially incompatible legal regimes around payments in two different countries. That is much harder than the technology problems here. It's not like you can just throw AI or more computing power at it and those elements go away. And the economics of payments is still so heavily determined by these thick market externalities where institutions are going to trade based on what is the cheapest and lowest risk. And although there are lots of comments about this and in these big reports, I've read dozens of these reports from central banks about their blockchain systems, looking at interlinking, and it's really unclear to me whether it's actually better and actually saves any money. But expanding dollar access comes with the trade-offs we talked about in terms of global financial stability of countries, and does the U.S. want to allow other countries to digital dollarize through these private stablecoins? And the final point is the main threats to the centrality of the U.S. dollar and this payment system is more about potential overuse of sanctions that would potentially force countries to choose between the US dollar and China, and undermining, which is currently happening to some extent, the domestic foundations of dollar dominance more than it is about any action that China is proactively taking or some technological disruption that might lead to new ways of doing payments. So that's it.
Thanks a lot, Martin. Let me ask you a few more questions. Of course, one element which really helps the dominance of the dollar too is the swap line arrangements. Do you see any connection between the swap lines and the payment system as well, or do you would say these are two separate items?
Absolutely. So you really want to make sure, if you have a dollar dominated payment system, people around the world, including that random small Indonesian business which might do business with a medium-sized Indonesian bank, they all need access to dollars. And if there's some time of crisis, it might be difficult to obtain dollars if the Fed doesn't have these swap lines and provide that emergency liquidity. So I think the swap lines is really crucial. And I don't know if I had it in that slide about undermining, but the fact that the Treasury Secretary had to say, or maybe it was the Fed, was saying, we'll try to make sure that those swap lines continue to be extended on a non-political basis. I mean, if that becomes a point of negotiation with the U.S. government rather than a non-political, part of the responsibility of having a dollar-dominated system, then that could be really, really risky. And to make people think, well, if I'm going to have liabilities in dollars and I won't be able to access dollars, then I need to do something else.
Great, thanks a lot. This was fascinating, but I have more questions as usual. If you look at the stablecoin regulation, of course, the Biden administration, Janet Yellen had this, there was a presidential working group outlining how stablecoins should be regulated and what the backing should be and all this. And the Trump administration essentially is redesigning that. Can you outline already the differences and what are the implications and for the dominance of the US dollar, the way you see it? Because it could be that something which is more tightly regulated is more dominating than something which is not so tightly and less trustworthy than, and might destroy or hurt the dominance of the dollar, or do you see it differently?
Sure. So I think the Biden administration, like many, struggled with what stablecoins would mean, and I think it was generally just very skeptical of crypto. And I saw this in China when different financial innovations were coming in, and sometimes the Chinese government decided it's better for us not to regulate it and have it be this Wild West that doesn't have the kind of imprimatur of the government, where people would look at this area and say, well, there's no way the government's going to guarantee it because they don't regulate it. They wanted to kind of stay away. But I think what we saw is that a lot of this grew despite the US administration not being enthusiastic about it. But I think you can see clearly that the Trump administration is really enthusiastic about crypto. But the industry has some unease. So the meme coin things like World Liberty Financial not really having any real value, but making a lot of money, really make a lot of the crypto people quite uncomfortable, because they believe that they're going to be building the financial system of the future, and that these kind of meme coin gimmicks are things that make it look like a fraud or a joke rather than the actual future of things. And I think it's interesting and positive that the administration is trying to support a path through Congress for this legislation, so that there can be actually codified rules rather than trying to regulate it. because that will create a much more stable foundation. And one of the most interesting things, we get back into politics, is that the crypto industry was by far the largest industry in terms of campaign contributions in the last cycle. So they have a lot of weight with both the administration and Congress. And actually, many Democrats support having what they would hope is a balanced regulatory regime that would allow these stablecoins to thrive rather than trying to regulate them out of existence.
But the challenge, I guess, is probably you make initial coin offerings, you get a lot of funds inflowing, you only back it to 50%. And instead of going to the taxpayer, it goes to some private individuals.
Yes. ICOs are bad. They are a completely failed experiment that flips everything the wrong way. As you say, you kind of raise all the money right away, and I'm not aware of a single initial coin offering, despite them raising at one point more money than all other tech startups through traditional venture capital funding total. I'm not aware of a single one that became anything like a successful business. All of them just either were frauds or failed or didn't really work out. So I think that's clearly a dead end, and I would separate stablecoins quite substantially from ICOs, because stablecoins are not really designed to create some business or become some new valuable thing, decentralized marketplace or whatever. The stablecoin is really just about creating a stable value that will be quickly able to handle payments.
Do you think the traditional banking system is more threatened by CBDC or more threatened by stablecoins?
I think they're more threatened by stablecoins. I mean, I generally think, if we think about CBDCs as a response to the threat of disruption from digital currencies, if you are in Nigeria, let's say, and you're concerned about the value of your currency in the future, there is no blockchain system that the government is going to come up with that's going to make you buy that over your domestic currency. You're going to see that as pretty much the same thing. But Bitcoin or a US dollar stablecoin is a lot more potentially attractive as a hedge against inflation in your domestic currency. So for a lot of the people who are using Bitcoin today, I just really don't see any of them going to a CBDC. I don't really see what CBDC does for people, and that's why I think we've seen there's no killer app that makes people want to use CBDCs in the retail space.
So finally, if you were to project yourself forward, and let's look at the global economy, where do you see the dollar dominance in 5 or 10 years? What scenario would you say? The stablecoins, you are bullish that the stablecoins will really strengthen the dollar dominance, and we will see the dollar in all emerging economies be much more dominant, and people using stablecoins on their smartphones or Google Glasses or whatever they have much more prominently than, and the local currencies will disappear or will be much less prominent.
Yeah, I don't think it'll be that quick. I do see that there will be an increased role. I think most people in around the world, it's just they're paid in their local currency, their expenses are in their local currency. Wouldn't necessarily expect that we immediately see a huge shift away, but I think it'll have some to some extent a significant market in these areas, especially if this Genius Act passes and they gain the full regulatory imprimatur. And then I think the interesting thing will be is if you start to see it really taking off, you'll probably see a significant response from the government authorities in those countries saying it's not legal to use these stable coins, or you can have a wallet but only a limited amount. And then we'll have to get into how exactly the stable coins are regulated and the wallets that trade them are regulated in each of those jurisdictions. And maybe some of them will circulate illicitly, kind of like Bitcoin exists in many of these countries outside of the regulatory framework. But I'm really concerned about the dollar. I think the general consensus is that there's currently a significant rebalancing away from the dollar. It's not really easy to put it all in one separate place. I think the EU has quite a steep hill to climb to really get a lot of that volume away from the US dollar. But part of this is because the administration has this kind of incompatible policy where Trump at times is, threatening anyone who tries to move away from the US dollar with sanctions or massive tariffs. The BRICS currency, for example, he said, if you try to create a BRICS currency, we're going to throw 100% tariffs on you. But then also, he really wants to bring manufacturing over, and many in his administration want to weaken the US dollar so that exports are more competitive. And this is an area where you can't have both. You can't have your cake and eat it too. And I worry that the way that they have weakened the exorbitant privilege of the dollar through their desire to weaken it and through maybe inadvertent weakening could lead to a really scary situation where that exorbitant privilege goes away. And if you have a serious financial problems in the United States, you might no longer have the flight to safety, which has historically allowed the U.S. to stimulate its way out of crises. And a deep financial crisis in the U.S. That doesn't get resolved quickly and can't be stimulated, countercyclically stimulated away, could be a very scary situation that could lead to a big exodus from the dollar.
I share this concern, but we always end it with a positive note in this webinar series. Can you perhaps raise another aspect where saying, there's actually some positive prospects that payments in the future will be, cross-border payments will be much more efficient.
Yeah.
Will help our global society in much better ways, or to see a positive dimension there too. And I can see this with US stablecoins, make it much easier to integrate further the global economy.
Absolutely. I mean, a lot of people don't have access to dollars in the current system, so giving them access to dollars, you think of a lot of people might not have a safe place to put money at the moment. So giving them something that's more stable, that's not just like Bitcoin, which could go up and make them rich, but it could also just as easily go down. Giving them something stable that's well regulated and can be, plugged into all sorts of interesting programmable money ideas and connected with AI. I think there's a lot of rich innovation to come.
Very good. Thanks a lot. We didn't talk about AI in connection to money, but perhaps next time we have to touch on this topic. Thanks a lot, Martin. It was fascinating. We learned a lot, and we stay in touch.
Sounds good. Thank you.
Thank you. Bye-bye to everybody, and I hope to see you next week again, where we talk actually about AI in a new session. Bye-bye.